Guys, Charles here. We're going to talk about limited reserves. This is what we've had, up until this year. This is what our Fed policy was. It's pretty straightforward. They're going to give you or tell you the economy is in a recession. You should be able to draw it, know how to draw that aggregate demand curve. We know that the whole goal of monetary policy is to get that aggregate demand to shift back to full employment. That's their goal, right? Is maximum employment, price stability. They want to get us back to full employment. So there's three tools they have that they can use to do that. One is that open market operations. You have to know it is open market operations, and they would buy bonds. They could also take the required reserve ratio and lower it. So the RRR could go down. We won't go into that any deeper because that is a deep conversation, or at least more complicated. The discount rate's pretty straightforward, though. The discount rate is just what we think of as Fed to bank loans. If banks need to borrow, they can go borrow from the Fed, and that is the discount rate. It is just an interest rate that they would be paying. So if the discount rate goes down, more banks borrow from the Fed. More banks borrow means there's more money supply. They buy bonds. That's more money supply in the system. The RR goes down. There's more money supply in the system. The discount rate goes down. The money supply increases. All three of these we know as expansionary monetary policy. Again, let's make sure we recognize we're doing limited reserves. Those are our three tools for limited reserves. The money supply would kick up. That's going to drive nominal interest rates down. As interest rates go down, investment goes up, and that seems to cause some confusion. But when we're talking about investment, we're talking about people taking out loans. So if the interest rate is 20% or 2%, well, which one would you rather pay to borrow money? I hope you said 2%, right? As that interest rate goes down to 2%, lots of people want to take out loans. Therefore, there's going to be more investment. It's going to kick aggregate demand up. Price level goes up. Real GDP goes up. Output has to go up. Recognize that you could show all that on your graph, right? We're recognizing that as aggregate demand goes up, output's increasing, price levels going up also. You should know that as expansionary policy. And obviously, this is going to, if output's going up, unemployment has to be going down. That tends to be our big reason why we're going to use expansionary monetary policy. The Fed wants to get us out of that recession and push aggregate demand back to full employment. We do have to know that that graph for limited reserves is the money market graph. It's money supply on the vertical, quantity of money, money supply is a vertical curve. Your demand for money or money demand is downward sloping. Nominal interest rates on the vertical and quantity or Q money on. As there's more money in the system, it's going to push money supply to the right. Now, if you don't have one of these three things going on for limited reserves, your money supply curve can't shift. So there's things that shift the money supply curve. There's things that shift the demand for money curve. We recognize clearly what shifts that money supply curve has to be one of these three things. So money supply would shift to the right, and that would drive down interest rates. We've already said that over here. We kind of understand it, but we do have to know how to draw the graph. That would take us in a recession and push us back to full employment. We're not going to go into how that affects the loanable funds rate, but that's a different video. Easy enough. We know what's going on with our money market graph. Obviously, if instead we were in an inflationary gap, we just flip everything around. So we should know how to draw our inflationary gap. Show us on the right aggregate demand on the right side of your long run aggregate supply curve. This is YF. This would be Y1. That would be PL1. Price level on the vertical, real GDP on the horizontal. We've got high price levels. We've got high output. Therefore, we've got low unemployment. This is a hot economy, what we call an inflationary gap. We just flip it all around, what we need to do, right? And I'm just going to start writing down here because this is kind of tightly written, which is, I think, nice for our understanding. They could just tell you it's an inflationary gap. They could also say output is above the full employment output. That is code for an inflationary gap. There's more output, actual output, is greater or above the full employment output. Well, this is full employment. If we've got more output than full employment, we have to be in an inflationary gap. They could also say actual unemployment is less than your natural rate of unemployment. Well, if we've got a lot of output, what we recognize is unemployment's very low. So our actual unemployment is less than our natural rate. And we should always just recognize that at full employment, that's your natural rate of unemployment. So if we got a hot economy, we got a lot of people working and not a lot of people unemployed. So just make sure you recognize that relationship. Again, 3 tools of the Fed. Let's see. Open market operations. And if it's an inflationary gap, they want to sell bonds, right? They want to sell, not buy, sell bonds. And they could also call them securities. They can sell securities, sell bonds. You and I should think of it as sell bonds. That's what we're going to see the most. They could obviously just flip it around, increase the RRR, or they could increase the discount rate. That's got to go up. All of this is known as contractionary monetary policy. And if that money supply, due to that inflationary gap, the Fed wants to lower that money supply. That's going to drive interest rates really high. That means investment's going to go down, aggregate demand goes down, price level goes down, real GDP and output go down, and unemployment would go up. Got to take it all the way to unemployment. That's important to know because lots of times they're going to have a multiple choice question that'll just say we're in an inflationary gap and the Fed uses contractionary monetary policy. What increases? You've got to know what increases in a contractionary policy is unemployment. Bond prices and interest rates are inversely related. Easy. Again, they could give us a recessionary gap. They could say, sorry, output is below full employment. We know if we're in a recessionary gap, we should be able to draw it really quickly. Aggregate demand, price level, real GDP. Yeah, that's not done very well, but you know what's going on. Sorry. Price level 1, Y1, here's YF. That's also incomes at full employment. That is our natural rate of unemployment. So they could say output is below the full employment level. We can recognize that at Y1, output is less than full employment. That means a recession. Or they could say unemployment is greater than the natural rate. If that's our natural rate and where output is here, we have to have more unemployment than the natural rate. Make sure you recognize this language meaning a recessionary gap. The central bank can use those 3 tools again. It would buy bonds. We talked about that. It'll decrease the RRR. It'll decrease the discount rate. All of those are what we know as expansionary. And expansionary policy, think about that. It's expanding. It's getting bigger. So we want the money supply to increase. That's going to drive down nominal interest rates. If interest rates are low, lots of people take out loans. Investment goes up. Aggregate demand, price level, real GDP, and output goes up. And unemployment would go down. Bond prices and interest rates inversely related. Interest rates go up, bond prices go down. Interest rates go down, bond prices go up. That relationship's pretty straightforward, but there's always questions about bond prices, but it's easy to figure out. All right, that was quick, dirty. Hope all is good. Let me know if I can help. If you need anything, WCWAUG, that's a G, H at AOL.com. Recognize that AOL account is older than you, so you can't laugh at it. All right, be safe. Take care.